Imagine a market where firms have zero control over prices. This is what economists call perfect competition. Hi friends, welcome to Econverse. I'm Abrar and I am a fellow student who has topped in my GCSE Economics last year in Oman. On this channel, we make learning economics simpler, clearer, and hopefully a lot more fun. In this video, we are going to be looking at perfect competition. Let's get started. In this video, we have the part 1 of market structures. In this video, we are going to be looking at perfect competition. So, before we head on to perfect competition, I think it's really important that we understand the fundamentals of market structures. So let's start off by understanding what markets are. Markets are essentially places where buyers and sellers interact to trade, buy and sell goods and services for money. So they are places where buyers and sellers interact to trade, or you could say sell and buy. And what is a market structure? A market structure, now this is really key. This definition is really important. A market structure is essentially the organizational structure or setup of firms in a market to determine the level of competition. So what it's done is it determines level of competition. Now let us look at the different types of market structures that we have. So when we look at market structure, let us look at the different types of market structures that we have. Essentially, when we look at different types of market structures, we do have perfect competition on one side of the spectrum, which is when you have loads of firms that are competing in one market. And then you have something called monopoly. Then you have monopolistic competition, and you do have something you call a oligopoly. So these are the four. However, it is important to note that you will not be looking at monopolistic competition and oligopoly at the GCSE level. The only two which are taught at GCSE are perfect competition and monopolies. In this video, we should be covering perfect competition. So let's get started. So when you look at a perfect competitive market, it's really essential for you to understand the characteristics of a perfectly competitive market. Let us start off with the characteristics. Start off on a new page. Okay, so when we look at the characteristics, firstly, in a perfectly competitive market, no firm has substantial market share. What does this mean? This basically means that no firm essentially dominates the market. That is the real key point here. And then you need to understand that both firms and consumers are price takers. What do I mean by price takers? What it means is that they do not set their own prices. The level of competition essentially goes on to determine the pricing. The firm cannot essentially set a really high price. They're not price makers, so they cannot essentially set the price differently to their competitors. And then another key important thing to note is that the output that is produced is quite standardized output. It's quite homogeneous. What it means by homogeneous is that they all have they're exactly the same product that is being produced by several firms. And then we have freedom to enter and exit in such markets. Freedom to enter and exit. What do I mean by enter and exit? So when you have a market, there are essentially new firms that want to enter the market, and there are firms that want to exit the market. By enter, I mean they want to come in and they want to take part in the market, and by exit, I mean they want to leave the market. So this essentially is quite, firms are free to enter and exit in a perfectly competitive market. And the idea that is important to note here is that they make normal profits in the short run. Normal profits in the long run. So they only make normal profits, and then they are not economic moats. So what do I mean by moats? Let me just explain that. MOATS, moats. What it basically means is, Warren Buffett had once said that an economic moat is one's ability to maintain competitive advantage. So essentially, no firm is an economic moat in a competitive market, because no firm essentially has substantial market share or any kind of domination over the other firms in the market. And then we have the behavior of the firms that we need to analyze next. Behavior of competitive firms. So the behavior of competitive firms can be, we can classify as prices are low. Then there's close substitutes. So as we looked, it's quite homogeneous products, so you can essentially get the same product from another firm. Close substitutes. Then you have the fact that they can change price only through quality. In order to increase their price, they will need to show a substantial improvement in the quality, and they need to respond, they have to respond quickly to market changes. So whenever the market trends change, they need to be quite quick in responding, because there's high levels of competition. And we looked at the fact that they earn normal profits. That is one of their behaviors. We need to understand that normal profits essentially means that it is included in the cost of production, and it is quite very, very minimal profit. What it basically means is that the amount of revenue that you're making essentially somewhat is break even, and there's very, very minimal profit that the firms can make, and it's quite low in the long run. Now let us understand how profits really look like. What do I mean by normal profits? It's essential to understand this key diagram. Profits in competitive markets. So when we look at competitive markets, it is key to understand that profits are quite normal or very, very low. So they're represented like this. On the vertical axis you have your cost, and on the horizontal axis you have quantity. You can draw the average revenue curve somewhat like that, and what happens is that the price is set, let's say, at that point. So your P, or your average revenue in other words, is here, and then you have, this is the break-even point wherein the cost and the average revenue meet. This is your average, I think this is your average cost, and that is your break-even. Break-even is essentially when your average revenue is equals to average cost, or total revenue is equals to total cost. And this whole area right from here to here, this represents profits. And the profits, as you can see, are very, very minimal, and over time they do begin to fade away. This is your Q1, this is your Q2, the optimal, beyond which it does become very, very little. That is what it means by normal profits in the long run. Now let us try and understand the advantages and disadvantages of competitive markets. Now, the advantages of competitive markets, if I were to write here, so the advantages are somewhat like this. The advantages are, firstly, it is productive efficiency. The firms are quite productively efficient. What do you mean by productive efficiency? If you remember, in one of our previous video, we discussed how there are three types of efficiencies: dynamic, productive, and allocative efficiency. And productive efficiency is when you keep the cost of production low. And since it's a very competitive market, there's high chances of personalized relationship with customers. In order to build any competitive edges, the firms may have personalized relationships with the customers. There should be a lot of, you could say, a good bond between the customers and the firms. And then you can say that there is a rise in variety or choice because there's very close substitutes. So there's high sovereignty for the customers, and then you have no advertising costs when you are in a perfectly competitive market. Now, when we look at the disadvantages, it is really pretty prominent in my view. I think that all three disadvantages are quite significant. Firstly, low profit, which is one of the key objectives of the firms, as we saw in one of our previous videos. We saw that they are price takers in this video, and as long as you're a price taker, you wouldn't be essentially able to determine your own prices, so that is a big disadvantage. And then the key feature of this market is competition, and that is its key disadvantage. Whenever you have a lot of competition, it reduces the chances for you to become dominant in your market. So that is it for perfectly competitive markets. In the next, if you think this video helped you understand economics better, make sure to give it a thumbs up and subscribe to join the Econverse. I'll see you again in the next video where we are going to be covering the final topic in microeconomics. If you think you know what it is, please let me know in the comment section.